Hey guys, my name is Alan Chen. I'm a CPA and the founder of Free Cash Flow Agency, the #1 dedicated accounting agency for e-commerce and online business owners. Today, I want to discuss the essential tax tips you need to know from running your e-commerce business and why it's key for thriving in your business for years to come. Let's paint this picture. You make $1 million a year and you think everything is going great. Your bottom line after accounting for your inventory and operating expense is $180,000, which is no small change, and typically you'll get about 18% profit margin. You have 3 owners in the firm and you each get to take home around $60,000 from your business. Not the best, but hey, you're just getting started and this is enough to live on and you can probably still afford your living expenses. And hey, that Tesla is possible. Let me go order that. But what if I was to tell you that your tax bill will be $20,000 for each of your partners? Suddenly, you're just down to $40,000 in profit, which amounts to about $3.3K a month. You're a bit tight on your money and you're shocked and wondering if you should return that Tesla. A lot of times, business owners are shocked at the amount of taxes they have to pay around tax time. And oftentimes, it is because they didn't do the proper tax planning, get ahead of the issues, and really know 5 to 6 months ahead what their tax bill will be like. My mission is to avoid the situation for you. I'm gonna tell you 5 step-by-step instructions for these 3 levels of e-commerce for online business income. From 0 to 300,000, 300K to 1 million, and 1 million to $10 million. Let's get it started. Let's start with 0 to 300K. These are the 5 things that you must be doing at this level. Number 1, understand what counts as a business expense. The hardest thing for someone just starting out is simply to understand what are the types of expenses that are tax deductible. Generally speaking, anything that is any way impacting or helping you run your business would be considered deductible business expense. Everyday example of this would be any software that you purchase to help with SEO or inventory management, hosting costs for keeping your website alive, shipping and packaging supplies, and even your phone and internet bill could account too. To help you understand all the different types of expenses that exist, I included a link to a PDF guidebook below in the description. Number 2, get a business credit card. This can help you keep your business expenses separate from your personal spendings, making tax time a whole lot easier for everyone. Credit card rewards can also help you earn cash back, giving you even more savings. A highly recommended business credit card is the Chase Business Inc. card, which has some of the best categories of point multipliers for online business owners. Number 3, learn to use bookkeeping software such as QuickBooks Online. At this beginning level of revenue, I wouldn't recommend engaging with CPA yet. You'll be better off learning how to use an accounting online software and keeping track of your expenses yourself until you get to a higher level of revenue. QBO also integrates with popular business tools like Shopify or PayPal to make tracking expenses even easier. Number 4, don't worry about making mistakes and keep charging forward. Tax laws are constantly changing, and it's inevitable that you will make some mistakes along the way. But as long as you are committed to learning from those mistakes and continue to optimize your tax situations, you will be successful in the long run. If you think it is hard now, wait till you get to that next tier of revenue where there's a lot more problems waiting for you. Number 5, keep costs low. Optimizing your tax situation is one way to save money on your business expenses, but you should also look for ways to reduce other costs as well. Consider cutting back on office space and overhead expenses, negotiate better rates with vendors and suppliers, and explore cheaper alternatives like outsourcing certain tasks or hiring freelancer when possible. By keeping your costs low, you can maximize your investment return and grow your business even faster. Next, let's talk about the 300K to $1 million level. These are the 5 things that you must be doing at this level. Make estimated tax payments to avoid penalties. As a business owner, you may be required to make quarterly estimated tax payments throughout the year. By doing this on time and avoiding any late fees or penalties, you can save money and keep your cash flow healthy. Number 2, don't forget about your sales tax compliances. Tax laws often changes, so it's important to stay up to date on your sales tax compliances. This includes collecting and filing all necessary forms, as well as remaining in compliance with any state or local regulations that may apply to you. By doing this, you can avoid hefty fines and penalties and help your business run much more smoothly. Number 3, hire the best talent, especially for all your accounting and tax work. Tax laws are extremely complicated and can be difficult to navigate on your own. By hiring a team of experienced accountants, you can ensure that all of your tax-related tasks are handled with accuracy and care. With the right help in place, you can relax and focus on growing your business without worrying about tax or financial issues getting in the way. Number 4, for people in the $300,000 to $1 million range, plan for your future with clever retirement plans. As an online business owner, it's important to plan for your retirement and make sure that you are prepared for the future. Tax incentives can help you save on your contribution, so be sure to take advantage of these strategies and start planning ahead. Number 5, and the last tip for e-commerce owners in the range of $300,000 to $1 million. Take advantage of cash basis accounting. Tax laws allow you to choose between accrual basis and cash basis for your business. Cash basis accounting is typically more favorable when it comes to minimizing your taxes, so consider switching to it if you haven't already. With the right system and processes in place, you can easily get started with a strategy and reap the benefits over time. Okay, finally we have arrived. These are the dream numbers that every business owner want to reach. $1 million to $10 million in revenue. And these are the 5 things you must do at this level to make sure that you stay on top and always get these numbers or beyond. Number 1 thing you must do when you're at this level is diversify your income sources. When your business has made at least $1 million, it's really time to start thinking about how to diversify your income sources. Although we will all love our businesses to last forever, more oftentimes than not, that's not the case. Businesses tend to die for a variety of reasons. The most common ones are cash flow issues, customer preferences changes, and lack of favorable economic market conditions. No matter what is the reason, no matter what is happening, business owners need to be prepared for the worst and start diversifying their income sources as soon as they can. Here are some tips to help you do just that. Invest in other businesses or real estate properties, and consider purchasing a stake in a different company in a different industry altogether. Alternatively, look into real estate investment and consider setting up your own rental property portfolio. Both of these strategies can provide solid returns on investment and will help you protect yourself against any potential business failure. You can also just diversify or do entrepreneurial opportunities by partnering up with other agencies or other types of business that are doing online courses or selling on a different platform than yours, right? Like Amazon FBA. With these options, you have more controls over your income streams, and you can continue to generate revenue even if your main business is struggling at any time of the year. Number 2. The number 2 tip for people making more than $1 million in their e-commerce business is tax loss harvesting. Tax loss harvesting is a technique used by many investors to offset investor gains or losses from other investments in order to minimize their taxes. Tax loss harvesting can be a great way to boost your overall investment returns, but it's important to understand the implications and take the right steps to maximize its benefits. Here are some tips for tax loss harvesting. Track your investment activity closely. Tax loss harvesting is only effective if you accurately track both your gains and losses throughout the year. Have a detailed record of all your investments so that you can accurately calculate how much you need to harvest in order to reach your goals. Number 2, consider options beyond traditional stocks or bonds. Tax loss harvesting may not always be possible with stock portfolios or bond holdings. There are often restrictions on when losses can be claimed or sold at a loss. When looking for other investment options, consider more liquid or less volatile investments such as real estate, private business equity, collectibles, and current cryptocurrency. Number 3, keep abreast of changing tax laws. Tax loss harvesting is an ongoing process that requires careful attention to tax regulations and the ever-changing market environments. Stay up to date on all relevant information so that you can be sure that you're taking advantage of all possible deductions when it comes time to file your taxes. By following these tips, you can maximize the benefit of tax loss harvesting in order to boost your overall investment performance and save money on taxes at the same time. The third tip for e-com owners in the $1 million to $10 million range: use the power of depreciation to acquire more assets at all times. Depreciation is one of the most powerful and invincible tax deduction tools available to all levels of business, but especially at this level as you have the capital to make large capital investments. Because business assets such as computers, copy machines, and other equipment wear out over time, you're allowed to write off or depreciate parts of the cost of the asset over a period of time. These tax tip guidelines on depreciating small business assets for the best tax advantages are what you want to follow. An asset is properly acquired to help produce income for your business. For tax purposes, let me show you the 6 general categories of non-real estate assets. Each has a designated number of years over which assets in that category can be depreciated. Here are the most common ones. The 3-year properties include things like tractors, certain manufacturing tools, and some livestock. The 5-year properties include computers, office equipment, cars, light trucks, and assets used in construction. The 7-year property include office furniture, appliances, and property that hasn't been placed in another category. With the advent of Section 179 and bonus depreciation laws in effect right now, it is the best time ever to take advantage of accelerated depreciation. For example, you can now deduct the full purchase price of equipment in the year purchased rather than depreciating it over a number of years. Section 179 expense deduction is a dry name for a deduction, but it allows you to deduct the entire cost, which is subject to certain limitation of an asset in the year you acquire and start using it for business. And yes, if you're wondering if I'm repeating myself, you can use Section 179 and bonus depreciation at the same time as a combo, but you just have to consider what is the best mix for you to get the best bang for your buck. But Section 179 do have some rules and limitations that I do want to point out. The asset must be tangible personal property, including software, so it can't be real estate. It must be used in a tradable business, so it gotta be active. It has to be active. You must take the deduction in the year you start using the asset. The decision to use Section 179 must be made in the year the asset is put to use for business. The deduction cannot be more than your earned income, so your net business income and wages for the year. For 2022, the maximum Section 179 deduction is $1,080,000. If your total acquisition are greater than $2.7 million, the maximum deduction begins to be phased out. If the business is an S-corp, partnership, or multi-member LLC, it cannot pass the Section 179 deduction on to shareholders, partners, or members unless the business has income. The individual must also have earned income to take the deduction. So this is something that's very powerful, very complicated, but as you can see, instead of having to spread it out over the years, it's something that you can take immediately start benefiting your business. So don't forget about these things. Number 4, make sure you have investor level financials. At the $1 million to $10 million mark of your business, there are going to be plenty of interested parties who would like to either invest in your business or just acquire the whole thing. And that's a very exciting position for a business owner to be in. And you don't want anything to stand in the way of you getting the huge possible valuation and payday for your business. After all, you work so hard to reach where you are. You want to make sure you get every penny you deserve from this business. One of the things you want to make sure you have is investor level financials. This is not just your basic bookkeeping. This is a premium level analysis of your financial figures, which includes an understanding of all your important metrics such as your burn rate, return on investment, profit margin, lifetime order value, churn, customer acquisition cost, and the rule of 40. You may ask, what is the rule of 40? It's mostly used by SaaS companies as a metric. The rule of 40 becomes somewhat of a simple financial framework to determine how successful a company is because it measures not only your revenue growth, but also EBITDA growth. I have seen the rule of 45 used as well, but it's not as prevalent. So the rule of 40 is your revenue growth rate plus your profit margin percentage should be greater than or equal to 40%. For clarity purpose, you can assume that the profit margin equals operating margin equals EBITDA. Here is how the rule of 40 looks. If you take your annual revenue growth rate and add it to your EBITDA, that number should be at least 40. The most realistic example is in the technology service industry is a year-over-year growth rate of 25% with EBITDA rate of 15%. That is a very achievable number on both ends because they equal 40% when you add it up, and will attract very qualified buyers when you decide you want to sell. If you subscribe to the rule of 45 as mentioned above, you just need to increase those number by 5%, which makes you a superstar, but in today's seller's market, rule of 40 is just fine. If your company is falling behind any of these key metrics, don't wait for a seller to tell you that, and then undercut your selling price. Make sure you're working with an outsourced CFO that's able to monitor all these metrics for you and let you know what you need to do to keep your valuation high so that when it's time to sell, you already know how much your business is worth from day one. Number 5, automate your workflow. Let the money work for you. As you now have the capital to hire talent, this is the best time to automate as much of the workflow as possible. Your time is more valuable than ever, and you want to surround yourself with a team that can make the day-to-day as smooth as possible so you can focus your attention on growing the top line only. Look into tools such as QuickBooks and Zapier who work with a tax accountant who can teach you how to automate your workflow for maximum efficiency. With the right systems in place, you can focus on being creative, developing new products or services, and growing your revenue streams rather than getting bogged down in the day-to-day minuteness of running a business. At this stage in your e-commerce journey, it's important to take advantage of all the resources at your disposal, aka your cash, in order to optimize your profits and time management. At the end of the day, managing your taxes as an online business owner is all about being proactive, taking action, and leveraging strategies that works for you. By following these simple steps that we have outlined above, you can save time and money and drive peace of mind knowing that your tax situation is under control. Let me know in the comments what you think about my steps above. If you have any questions about how to do, what to do at your revenue level, feel free to drop me a comment and I'll try to get back to you as soon as I can. And of course, you can always get on a call with me if you're ready to take the next step in growing your business and making sure that your compliance is worry-free. Thanks again for watching, and keep rocking off and taking your business to the moon and back. See you guys next time. Alan out.